Happy Thursday, everyone. Welcome to the Paul Levine Show, sometimes known as the Frickin' Frack Show. We're going to talk about, we've got Paul Levine here, Fred Sams, Patty Withrow. I'm Greg Dixon. We're going to talk about we're going to review the 3 reasons to invest in commercial real estate. And we're going to go into a deeper discussion about cash flow, which may be one of the main reasons why you would invest in commercial real estate. So, Paul, do you want to kick this off?
Yes. Thank you, Greg. First of all, everybody invests in commercial real estate for different reasons. You have some people who just want to build something for their ego. You have some people who want to build something for their families. You have some people who have needs. Needs, wants, and desires is the way I like to put it. And they have specific needs, wants, and desires that they have to satisfy. And when each one of these individuals looks for what type of investment they should make, they are either going to choose that they are investing for the immediate and future cash flow, or they are investing to get appreciation, and they are also investing to get some really, really nice income tax benefits. And in the first couple of shows in this sequence, we talked about cost segregation studies, and that is the trigger for getting the income tax benefits. Now, cash flow. People in different situations may have different needs, as I said. People who are looking to retire are looking for a reasonable or better cash flow than people who are still working every day and putting in their time. People who have heirs to leave assets to, like apartment buildings or self-storage facilities or shopping centers. And they want appreciation because there is a little tax trick that I know that either we'll mention it today or next week, but it's a little ahead of our time, but it's a great way to really benefit you when you invest in real estate. And the third thing, as I have mentioned over and over again, having been a practicing CPA for over 50 years, is the income tax benefits that you get from investing in real estate. There are some savings when you invest in real estate and income taxes, but there is one huge deferral. There is something that gives you incredible cash flow today that will benefit you over time. And it's almost like getting an interest-free loan from the government. And can you imagine getting an interest-free loan from the IRS? Nobody ever thought that would happen. But the IRS is part of it. It is part of the regs, and it works very, very nicely. Now, getting into a little bit of cash flow, and Fred will be joining me on this in a little bit, but different investments give you different amounts of cash flow. There is an expression: the greater the risk, the greater the reward. So if you want the most safe asset that you can invest in real estate, your return is going to be lower, excuse me, than if you take a higher risk and invest in something else. For example, there's something called a triple net lease. And a triple net lease we will go into when Fred joins us, but is one of the safest investments that you can make. And then I am sure that all of you out there are aware of what cannabis is. And cannabis is growing as far as an industry by leaps and bounds. But it isn't as safe as a triple net lease. And therefore, the greater the risk, the much greater the reward when you invest in cannabis. And Fred, you want to join me and let's talk about some of these things?
Well, Sparky, you kind of went off the on a tangent there with the cannabis. But where I would kind of draw that in is, you know, when people look at investing, they, as my partner mentioned, they look for safety. They look at how do we mitigate risk. They look at how are things risky versus taking risk. And when we sort of put those to, when we look at those from a different lens, we start to understand that there's just a tremendous number of opportunities out there. And the one point to be made alongside the cannabis is that I heard a young man say, in fact, it was one of my sons, and he said, "You know, Dad," he said, "the cannabis is the new gold rush in this era." And and at the time when he spoke about that, it related to being involved in that business at the retail level, or at a level, at a different level than what myself or my partner might examine it from. Okay, what I'm saying here, as it applies to triple net, there are all different types of retail businesses that'll participate as a triple net. And let's always start to think about and tie back to what I was speaking on risk versus being risky. The risk on a triple net lease would not be on the investor side, because by virtue of what a triple net lease infers or stands for, it's having that person who is renting or who is leasing the space, they're paying the taxes. They are paying all of the expenses that are encumbered with doing business on that space.
Well, let me just itemize. They're paying the insurance. They're paying the repairs and maintenance. They're paying the utilities. They're paying everything. Go on, Fred.
No, absolutely. So then, if let's look at that from the standpoint of a strip mall or a shopping center or an industrial space or an office building, any and all of those assets could have leasers. Wait a minute, lessees. I get my C's and soars kind of mixed up in those assets. And there are different ways that they could participate, but let's only focus on the triple net, because again, from both sides, that gives the most a benefit than that by the lessee being the one that's being responsible for those. Well, then those are their tax benefits as well too, and then that just really makes for a revenue generating opportunity for the person that's going in it.
Fred,
I
let
don't
me
want
just
to get
add something that may bring this together for people who are watching. And that is, when I think of triple net leases, I think of McDonald's. I think of Arby's. I think of Walgreens. I think of these buildings that are out there and for the most part freestanding, where the company like McDonald's would come to you and say, "Mr. Investor, we need a building here. We need a McDonald's on this corner. Will you invest in this with us?" And what happens is McDonald's basically builds it to their specifications, figures out all of the expenses and everything else, and then sells it to the investor and leases it back from them. There is an expression in real estate and in taxation. It is called a sale and lease back. And now I'm going to stop interrupting Fred.
Oh, gee, what brought that on? Don't stop now. But that's a good point. And let's talk about when these exact businesses that Paul's referring to. They're what we call on the broker side. Those are called anchors, and an anchor establishes credibility. An anchor establishes security. Let's take a look and think about that whole era of big box. And I think Best Buys are one of the few companies left that we would still refer to in that case. But there were a handful of dinosaurs that aren't around anymore. They occupied huge spaces, and we're talking about maybe 150,000 or larger square foot places. So to put that in some frame of reference, maybe that's the size of a Costco or this type of thing. And literally they were the anchors. And so within that space, that strip mall or shopping center space, they drove traffic. And they drove traffic for all the other multi-tenant leasers that occupy spaces. That might have been the video game store. That could have been just a handful of other businesses. And in their best marriage, they're going to be closely related. So if you have a Best Buy there, then you also have, as I mentioned again, a video games. And
Okay,
depending on what your demographics are that surround it, you have others.
We're getting into the technicalities of a strip mall or something like that. We should be talking about the investment side of the of each of those investments or leases. So
Absolutely.
there are people who invest in strip malls, and there are also people who invest in just malls, huge buildings that house God knows how many different stores and a food court and all of these things. And and what you do is you look at how much you're going to invest. You look at what's the safety in that. What are the possibilities that things can go wrong? And I will tell you, I am 77. I have been or was a practicing CPA for over 50 years. At the beginning of my career, people would say, well, this is a safe investment. Nothing can go wrong. And for the most part, back in those days, they were right. But now times have changed. And I have an expression that I use over and over again, and that is that guaranteed isn't here anymore, because things have been happening over the years as the economy and as society is changing from one phase to another, that guaranteed returns on investment, guaranteed lifestyles, anything that people say are guaranteed isn't guaranteed anymore. So you have to look at the returns that you're getting on these investments in that regard, because years ago you may have gotten a lower return, but now the return may be a little higher, and you may be looking at different investments.
I would add to that I agree in point, and I would also mention that there are some things that are just always going to be good investments. I mean, let's face it: Tide, Clorox, bleach, diapers. Some of these things are never going to go away. There are a handful of businesses and opportunities that have gone by the wayside for one reason or another. And yet that's where those opportunities, yet new opportunities arise. So when we start talking about that space that you're talking about, there are lease periods. And depending on what type of business, for example, a McDonald's or Walmart, they're going to get established as an anchor. And inside of that shopping space, a strip mall that they're going to occupy, they're going to look for a longer term lease. Why? Because then they're going to get better terms. Whereas that smaller entity, they're going to take typically shorter terms. Their terms are not going to be as long, i.e., because what they're paying is going to be attached to the square foot price that they pay, that they lease that property for, as does the Walmart, etc. And those are going to be a whole lot different. So,
what are we looking at, long term versus short term? How many years differences?
That's right. That's right. And so, you know, as we look at those things again, here were a few different propositions. At one point, if Paul and I were presenting a strip mall opportunity to a client or to a group of investors, for example, there would be the benefit of that end number would be, what is my return on investment? What does my cash and cash look like? What is the internal rate of return? In addition now, and what makes this, in addition to those things, we can take the tax strategy of cost segregation, and now we're adding in the ability for them to accelerate the depreciation. Because remember, again, the beauty of real estate, is it both appreciates in price, and it also, the depreciation factor, you're able to accelerate. And then now we're talking about the time value of money. And when we look at those things, let's be clear. What does that look like if I go into a corporate investment as opposed to say a multifamily or a home, for example? Well, the type of land improvements we could be talking about could be the concrete pavement, sidewalks and pads, curbing, retaining walls, storm drainage systems, water retention ponds. I mean, I could go on with the type of things that then go down from 39 years, which would be the typical way of taking that item, and now taken with a cost segregation study, being able to bring that down into a shorter period and hence bring more tax savings. On the 5 and 7 year side, decor signage, custom cabinetry and counters, ornamental woodwork, carpentry, vinyl, etc. Just a lot of the things that, as you start to take that asset and expand it and really have the cost segregation engineering based studies done to analyze that, you bring in a whole different world. And that's to take nothing away from the tax professional, but yet understand what we're providing to them are solid numbers that they can then take in and maximize those for their client.
Okay, let's go back to the investment side, because we talked about cost seg a couple of weeks ago. On the investment side for that McDonald's or that anchor that Fred referred to, you could be talking about a 20-year lease, maybe even a 25-year lease. And leases like that call for guaranteed increases in rent, for example, every 5 years or so. Whereas the smaller stores in the strip mall would sign leases for maybe 2, 3 years, or maybe 5, because they don't have the sticking ability that a McDonald's has had.
But they will have the same they will have acceleration clauses the same way, partner. They just won't be, they'll be different now.
Right. And the way I look at it is, if you sign a lease with the McDonald's, they can almost print money like the government can. I mean, that there is going to be a check in the mail every single month on the same day, because they are going to pay you, come, as my expression goes, come hell or high water. They are going to pay you. And in some cases I've seen this, even where a McDonald's has a certain location and then they close the store, they will continue paying you because they are obligated to, and they want their good name to stay a good name and to be out there for the public. They don't want any negative publicity.
Well, you know what? McDonald's claim to fame has always been location, location, location. So I've yet to see where a McDonald's was, and then they're no longer, with the exception of, well, I was going to say, with the exception of in my neighborhood, I'm in the university area, and they took and closed down a McDonald's right in the college area, but they built a student in its replacement, because it sat on a large piece of property. They replaced it with a 5-story student housing, and then on the first level is mixed use, which now has McDonald's and 1 or 2 other fast foods. So it wasn't like they got rid of it. I'm saying in most cases, unless the train station goes from here to there and moves over, McDonald's is pretty good about predicting space. Now, in the other cases, there have been some big box stores, whether they were the Targets or a handful of others, and they have moved. And what happens? There's a term we use on the commercial brokerage side. That space goes dark, because it's not just the fact that then the large anchor is going to continue to pay, but you have to also consider, and this is where that risk and reward factor comes in, how the smaller, what happens to the traffic that McDonald's or that big box drove to that space. That doesn't just affect McDonald's. It's nice that they are in a situation where they'll pay it down at a lesser rate, but the real effect and the risk then has to be measured by all the other single multi-tenant lease businesses that were affected by the traffic decline that immediately came into place. Just want to
Yeah,
throw
if
that
you
out.
lose your anchor, a strip mall or even a mall will be drastically affected, and all of the stores will then be affected as far as number one, how much money they're making. Also, consider that many of the other stores are not big conglomerates like a McDonald's or a Wendy's or any of those, and they start losing money. They don't have the staying power to keep investing their money into the business to keep it going. So a strip mall can go from doing very well to not doing anything in a relatively short period of time. And
That's
yeah, and the other thing is that there was the McDonald's locally that did close up, and I am sure that they kept paying based on the lease, um, and they fulfilled their obligation. They're not going to let anything happen to sully their name at all. Um, so we're talking about cash flow. We're talking about triple net leases. Now, any real estate investment is going to have cash flow. And you look at different investments and you look and see what the cash flow benefits may or may not be. For example, I happen to really like multifamily housing, apartment buildings. And apartment buildings give you both cash flow and appreciation. But the cash flow, excuse me, in a shopping center is not nearly as high as the cash flow in, for example, the self-storage facility. Self-storage facility has high cash flow, lower appreciation. Apartment building has much higher appreciation and lower cash flow, and adequate cash flow, but still lower per square foot or however you want to look at it than multifamily housing. And you have to look at what, like I started out today's seminar with, look and see what the person's needs, wants, and desires are. If someone is looking for that long-term lease on life and retirement, and maybe they're in their 50s or early 60s, and now I've seen people retiring a lot earlier than that. If they have the right mix, the real estate investment portfolio that affords everything to them, they will get that cash flow enough to retire. But you have to balance things out. And one thing that Fred and I do that helps is we go over and make up the right mix of real estate investments to give you that cash flow appreciation and income tax benefit so that you can retire depending upon what your desires are. Um, Cash flow through self storage is really a very nice investment. Cash flow, self storage is low management. You don't have to be there full time. You can set everything up, and I will reach for my phone. Every time somebody pulls into the self-storage facility, you get a ping. Every time they go into their storage facility, you get a ping, and every time they leave, you get a ping. And the tenants pay online. So you can do self-storage facility with minimal management, say a retiree, and and you have to give something up. And what you give up is you give up some of the appreciation that you will pick up if you have an apartment building. And let me give you the reason that we have these differences. An apartment building gives you appreciation over cash flow. Appreciation yields capital gain tax or capital gain income. Capital gain income is taxed at up to 20% and no more, whereas ordinary income can be taxed at up to 37%. So if you're looking for the monthly cash flow that a self-storage facility will give you, you're going to be getting a higher rate of return, but you'll also be paying more income tax. Whereas on the apartment building, you're going to balance it out. You'll have more appreciation and lower income tax. And then you have to really look at what the future holds for you. What do you want to put these things in, and how do you want to balance your portfolio? And remember something, your needs, wants, and desires today, not the same ones as you're going to have in 5 years or 10 years or even longer. So you must. I use IA, and every time I write you have to, it tells me I should use you must. But in this case, you must plan on what your needs are today and then look at it in 3 years, in 5 years, in 1 year, at increments, and you do it critically so that you don't lose sight of that goal. And the first thing you do is you keep saying to yourself what that goal is, and you have to see if that goal changes over time. Fred, I'm dry.
Yeah, no, that agreed. I guess I would maybe sort of direct it toward the opportunity. Certainly some of those same folks that Paul talked about, maybe in their 60s, 70s, or even older now, I think folks are just staying in opportunities longer. The fact of the matter is, by taking in and enhancing the security, by automating the ingress and egress, I mean, these are just simple things that can then be implemented inside of a storage facility that could then reduce the need and then increase your bottom line of having on-site management. So, a person could either take a look at staying in an opportunity that they've initially went into 10, 20, 30 or more years ago, and just holding on. At the same token, we see these same opportunities arise, not just in storage, whether they're in boutique hotels, strip malls, again, just a whole plethora of different asset classes where the investment, where those that invested in them did them some years ago, and the thought, need, or sensibility, and even the technology more so, as Paul pulled up his phone, is all there to really implement at a different level. And so these make for great opportunities, in addition to multifamily, in addition to some of the other uh, opportunities that we just immediately cling to. And if we're really starting to look at, and this is where Paul and myself are really able to sort of open up and peel the onion for folks, where these opportunities lie, and how to go about them. Because again, the golden rule with real estate is you make money when you buy. So when you go in, that's when you make your money.
Now, there is one thing we're getting down towards the closing time. I do want to bring something up that you've got to be aware of. Everybody is trying not to pay income taxes. Everyone is trying to pay the least amount of income taxes that they can. And in real estate, everybody looks towards what is known as a Section 1031 exchange in order to not pay income tax on the property that you are just selling, but maybe pay it all the way down the road. And as a tax strategist, I have a real problem with that, because what the investors, not the accountants or the attorneys, but what the investors see is I'm not paying income tax. But what I saw and still see as the advisor is I see that every time you sell something and do it with a Section 1031 exchange, you are reducing the basis, the cost value of the assets that you acquire by the amount of the gain that you are not paying tax on. We call that deferring. And if you do that once, maybe that's okay. But there are people that like to do it once, twice, three times. And each time they do that, they get lower and lower basis for the assets that they are acquiring. And the problem is, all of the wonderful work that Fred and I can do with cost segregation goes out the window, because the asset that you're acquiring, because you keep reducing that value by the deferral of income that you are, passing on, could be a real problem, and you're not going to get the cost segregation benefits that we talk about all the time. But there is one part of tax planning that works beautiful for it. And I hate to be the bearer of bad news, but it comes when somebody passes away. And if you, I hate to plan correctly and know that someone is going to be passing away in some reasonable time, either based on their age or their health, that when they pass on, and if you are one of their heirs, when they give you that property, you get it at fair market value. So all of a sudden, the basis of the assets that you are depreciating go from here all the way up on top, because you go from book value to fair market value, and you don't pay any income tax on that higher number, or on the difference between the lower and the higher number. I'm going to be bringing this up more than once, but I want to tell you a quick story. I went golfing one day with a dear friend up in Santa Barbara, California, a while back. And there was a foursome, and I knew all four guys, but one of them was a close friend. And we were on the third, fourth hole, and one of the guys makes the comment that his father is very ill and they have to sell his primary residence, his home, in order to pay his medical expenses. And then we go a few more holes, and I started asking a few questions. And by the time we were at the turn at the ninth hole, I figured out what he should do. And what I told them to do is to go out and get loans, real estate loans, remortgage, refinance that property, and pay the medical expenses with that money. And then when his father would pass away, and it was inevitable, when his father would pass away, he would acquire that property at fair market value and sell it and not have a penny gain or a penny loss. And that's exactly what happened. And he paid for lunch.
In other words, what you're saying is you're a cheap date.
Lunch was good though. Guys,
that was a huge savings. That was tremendous when you think about it. That little snippet that you offered to them, and then the implementation of it, really saved them a lot. They made out huge.
And I could have charged for that type of advice, $5,000. But you just have to know everything that I learned over 50 years gives me the ability to take the facts and run it through my sifter of knowledge and know which pieces to use.
So how was your golf score that day?
I happen to love golf. I can't do it anymore because I have a bad back. But I was a big Arnie Palmer fan. But then when Tiger came on, my wife and I started.
He asked you what your score was, Sparky. Tell him the score.
I've never shot under 100. I shot 100 once, but I had fun, and I got out in the fresh air. I got some exercise. I was with friends, and it was wonderful.
I can do that in 9 holes. I get lots of practice. I get good value for my tee fees.
How many boxes of balls do you have to bring?
No, I actually I hardly ever lose any balls.
And
But
the water hazards?
once in a while in the water hazards, but mostly I'm a very occasional golfer, and I have a hard time getting the ball off the ground. So then I tend not to lose them.
Amazing.
Worm
Amazing.
burners, they call.
So my comment for our audience is that the story that Paul just told is one example of how he puts his relationships first. I've been working on some putting together some books, and I can tell you from the articles I've read of Paul's that this is only one example of the way that he approaches business, which is being with people on a creative level and in a caring manner, and again with a ton of experience and knowledge. And so get involved, follow this link, pick up the phone, and take advantage of the incredible expertise that these two gentlemen offer, because they're the top of the line.
Well, I will tell you next week, I will tell my biggest of all war stories. And then they will see what I can do or what I did do. And it still amazes me what I accomplished.
No, that's probably
And
true.
also the fee to the client, which could have been anywhere, 30, 40, $50,000, he bought dinner.
Well, we got a few more mouths to feed, so there's a little more involved in that there, Sparky.
Now, as I get older, I know that I need money to retire eventually, but I love what I do. Why would I retire?
Yeah.
No, that's a whole other topic.
Yeah. So speaking of topic, what is the topic next week going to be?
Well, we're going to continue on the cash flow concept with why you invest into real estate. And then probably the week after that, we will get into more of the appreciation. Because everybody's got to realize what those 3 things are, not the names. I mean, everybody can reiterate cash flow, appreciation, and income tax benefits, but you got to see what it is and how to get it and how you have to set things up.
Sounds awesome.
It'll be fun.
It'll be fun. Yeah. Okay. So any last comments or questions here from the audience or Betty?
No, I said my piece.
Just everybody should have a safe week, and we should all be back here next Thursday.
Okay. See you next Thursday.
Take care, guys.